Welcome, everyone, and thanks for joining us for today's webinar, a U.S. Treasury rate update as part of our Beyond Insights series. I'm Justin Wheeler, CEO of Berkadia, and I'm thrilled to be joined by the Chief Market Strategist for Jefferies, David Zervos. David is the head of the Global Macro Division of Berkadia Asset Management. He joined Jefferies in 2010 after spending 2009 as a visiting advisor in the Division of Monetary Affairs at the Board of Governors of the Federal Reserve System in Washington, D.C. Prior to this stint, he held a variety of research, sales, and trading positions in the private sector, most recently managing global macro portfolios for Brevin Howard and UBS O'Connor. We're fortunate to have him join us today to better understand what we're seeing on the 10-year Treasury yield. It's been an interesting year and an especially intense past few weeks as we've seen yields on the 10-year take us on a roller coaster ride, primarily up. I'm eager to stop talking, get out of the way, and give David the stage. Welcome, David.
Thanks, Justin, and thanks everyone for tuning in. I'm going to talk for about 20 minutes and then we'll open it up for questions, 20 or 25. And I thought I'd start really by taking you back in time to the beginning of this year so that we can set the stage for what's gone on this year and better understand what's about to happen in the end of this year and into next year. If you go back to December of 2022, you could look at the surveys of professional forecasters of the economy. The Philly Fed puts one out. There's a number of other professional forecasting surveys that are out there. And they all pretty much have the same outcome, that folks were predicting, I think about 75% of folks, the professional forecasting community, were predicting a recession now, meaning Q3. We were going to have 2 consecutive quarters of negative growth. If you looked at the Federal Reserve's forecast, they were predicting almost zero growth in the first half of the year. And if you looked at the markets were predicting through the SOFR curve rate cuts at the September meeting. So it was a very somber outlook to start the year. We had over 400 basis points of rate hikes in the system. Inflation had not yet come down anywhere near to the 2% target. People were talking about stagflation and a Fed that had lost its way, and quite a lot of, I think, angst. And certainly, I think from the investor standpoint, in what I saw, a lot of people who were very concerned about taking credit risk, taking equity risk, taking any kind of risk, and were really more focused in on duration and betting, at least in the initial stages, on the idea that the Fed would have to be slashing rates very soon. Well, as we sit here in October, the outcome couldn't be further from the truth. We had over 2% growth in the first 2 quarters of this year. And in fact, this quarter, Q3, that's just passed, looks like it might be closer to 3% or even higher, depending on whether you look at the New York or the Atlanta Fed surveys going into it. So I think it's important to understand what was it that got the Fed, the market, and the professional economists all twisted up. And I think this goes back to some of the early pieces that I was writing in February. And one of the reasons I tried to stay with our clients more constructive on the economic outlook and more focused on taking risk, particularly credit risk, which I saw as more interesting than equity risk this year. And we can get back to that at the end. But one of the big sources of confusion was the balance sheet of the Federal Reserve. And I just want to do a little bit of a historical recap because the Fed doesn't like to talk about it. Actually, nobody likes to talk about it because it's a very confusing and very new thing for us. We haven't really used balance sheet tools very often. We have, decades of cycles where we've looked at interest rates and curves and everything to do with policy as it's viewed through the rate cycle. But when we got to the zero bound in 2008 and first brought in QE and then unwound it a little bit and then brought it back in again during COVID, we sort of have just pushed the balance sheet to the side and said, well, I kind of just hope that goes away and we can just talk about rates. That's what central bankers thought. And I think that's a really dangerous thing to do because the balance sheet was crucial in getting us through the global financial crisis and crucial in getting us through the COVID crisis. And the effects of these balance sheets are lingering with us. And what I want you to take away today from this talk is that we still have inside of us as an economy, as a patient that was on the operating table in stressed periods, both in the global financial crisis and during COVID. We still have in us the painkillers that were delivered through unconventional monetary policy, through the balance sheet. When we got to the zero bound, the Fed brought in these purchase programs, QE1, QE2, QE3, QE Infinity, and then, of course, the very large QE programs that came back in 2020 and lasted for quite some time, all the way through 2021. What I want to give you to think about this properly are a couple statistics. Our balance sheet 18 months ago in the U.S. peaked out at about $9 trillion, which was 40% of GDP. Prior to the global financial crisis, it was 5% of GDP. And prior to COVID, it was about 18% of GDP. So we have an extraordinarily large balance sheet by historical standards. And one way to think about where we sit today, we've seen a little bit of runoff, $8 trillion, which is a little over 30% of GDP now. One way to think about this is to think about what it would be like if we took the balance sheet back to where it was, not necessarily before the global financial crisis, but just back to where we were before COVID, back to 18% of GDP. I want to do that with you because I sort of feel like that period of time was about as neutral for monetary policy as any time in our recent memories. We had an unemployment rate at 3.5%, a generational low, 50-plus year low. We had the inflation rate basically at target or a little bit below. We had the yield curve pretty flat at around 2 to 2.5%. There weren't a lot of cuts or hikes priced in. Everything felt neutral. And we got there after a decade of really unbelievable policies that got us out of what looked like in 2009, a decade earlier, the second coming of the Great Depression. But I want you to think about the amount of extra stimulus currently in our system relative to the period of Q4 of 2019 before COVID. And the answer is that it's about 12% of GDP, or something very close to $3.25 trillion, $3.2 trillion to be exact. So we have $3.2 trillion more in excess reserves, cash in circulation, and proceeds from the reverse repo programs that the Fed run. They also have assets that are $3.2 trillion larger than they were before. And that's an important fact. And I'm adjusting this for the size of the economy. I believe the big miss in the economy and the big miss on rates and the big miss on why things are okay is because we have all this extra stimulus in our system, because we have what amounts to 2 doses of QE1 still in our system. And that is, if you remember, QE1 was about $1.75 trillion. That is an enormous amount of balance sheet stimulus that is a residual in us, that is a painkiller that's in us, and is, in a sense, nullifying at least a part of what has been put into the system to slow the economy down, the 525 basis points of rate hikes. The way I've tried to map it out for clients and put it back into rate terms, and there's no right or wrong way to do this, I think this is more of an art than a science, is to sort of try to translate what is $100 billion of QE or QT worth in rates. Is it worth 2 basis points, 3 basis points, 5 basis points, 7 basis points? When I was at the Fed in 2009, I think a lot of people had settled on some pretty big numbers, like 7, 8, 9, even 10 basis points. I think a lot of people have tried to make that smaller through time, largely to try to make the balance sheet go away. But I think you can make a very cogent case that the stock of QE in our system is worth at least a couple hundred basis points. And if you buy that argument with me, then rates really haven't gone to the levels that we think they're at. There's a sort of stock adjusted level of rates that's in our system. And it's not 525, it's more like 325, which sounds a lot different and feels a lot different. And I think is consistent more with the type of growth that we're seeing. we went to a very accommodative place with QE and zero rates during COVID. Maybe the QE stock adjusted rate then was -3, -4, -5 or more. And now we're just getting back to smaller positive numbers. If you think about it in this way and you believe that the balance sheet, as I do, is still offering quite a bit of stimulus to the economy, I think it really helps you get your head around why we haven't had as many accidents, we haven't had as much pain, GDP growth has been strong, the unemployment rate has been low. I think there's another feature of the balance sheet that's not just related to its size and the liquidity and the lifeblood of liquidity that it puts in the system through the liability side of the Fed's balance sheet, through the reserves and cash and the sort of money, high-powered liquidity. Sorry. It's also the asset side. And this is something I spent a lot of time with writing about with clients and discussing with clients back in February and March of this year, when I really became convinced that the narrative that most had settled on for this year was just a false narrative of imminent recession and imminent rate cuts. On the asset side of the balance sheet, if you go back to the pre-GFC period, the Fed really just owned T-bills. It had T-bills, it conducted repos, reverse repos, it tried to hit the Fed funds rate, it would withdraw reserves, add reserves, and that was it. It's pretty boring, to be honest with you. Now the balance sheet is made up of long-dated securities. There's over $3 trillion worth of 30-year agency MBS on the Fed's balance sheet. There's 30-year bonds that the Fed bought at par, which are now trading with $40 prices. They've lost 60 points on these bonds. They hold an enormous amount of duration. Now, in the old days, the days that we like to compare things to and say, oh, what did a rate hike look like in 94? What did a rate hike look like in 82? What did it look like in 73? What did it look like in the 60s? Those were all periods where the Fed really didn't have much of a balance sheet. Didn't have duration, and it didn't have size. Now, when the Fed's raising rates, actually what's happening is they're socializing a large quantity of the losses that would normally be in the system. Today, the Fed's balance sheet on a mark-to-market basis is down close to $2 trillion, probably about $1.7 trillion where we sit today. If we had to take those, if the banking system, the insurance companies, the money managers, the sovereign wealth funds had to take that, along with similar losses from the ECB that have been insulated by the ownership of long-dated securities, I think we would be in a far different position. Think about it this way. In our financial system, there are creditors and there's debtors. And when rates rise, the creditors who have bought a security at a fixed rate tend to lose, and the debtor that locked in a low rate tends to win. If you get a 30-year fixed rate mortgage at 3% or 2.5%, or in case of some of my colleagues in Italy, they were able to get 25-year mortgages at 50 or 60 basis points, you're the winner. The liability side of your balance sheet shows huge mark-to-market gains. The value of that security is down at 80 or 70 cents on the dollar. But the mirror image of that is that someone owns that mortgage in a pool, and they bought it, and they have a security on their books that's down from par to 80 or 70. But in the old days, before the central banks owned any of this, you had one winner, one loser. It was a zero-sum game. There were no wealth effects. You didn't need to think about what this meant for the economy. Now, I have a whole bunch of winners that have locked in low rates, and a lot of the losers, I would say close to 25 or 30% of the losers, maybe more, because the central banks have bought almost $30 trillion worth of securities if you add them all up, and there's $130 trillion of marketable debt outstanding. The losers, in large part and in many ways, got taken out. So now I have winners and no losers. It's not a zero-sum game. I actually have a positive wealth effect in the macro economy that comes along with higher rates that feeds a stimulus back to the system. So now I have liquidity driving economic activity at a very high rate because of the size of the balance sheet. I've got the asset side immunizing or socializing losses, I have a lot of reasons why policy is actually not that tight. And if you go down this path with me and you kind of look at rates, not where they are, but where they are adjusted for the stock of QE, I would argue that today, real interest rates, which everybody looks at and says, oh, these are about positive 2%, and they're up from negative 2%, long-dated real interest rates, I would actually say they're actually probably closer to zero on a stock-adjusted basis, a QE stock-adjusted basis. And the starting point was about negative 4. So we had very easy policy, and now we have kind of neutral to maybe slightly restrictive policy, if even that. We got growth surprising to the upside. We got employment surprising to the upside. And we have a Fed that really hasn't crushed the economy nearly as much as it would have appeared if you just looked at 525 basis points without considering the balance sheet. That was the big miss. Now, this also tells another narrative which is very important for the economy. And that is that the inflation that we've all lived through, the big rise up in 2021 and the big collapse starting in the middle of 22 to today, it's a narrative that's really hard to tell in a demand-driven world. And what do I mean by a demand-driven world? If you listen to Larry Summers, Mohamed El-Erian, Bill Dudley, many of the talking heads, they would have told you that inflation was up because the Fed was too easy and aggregate demand was being stimulated, growth was too high, and that the Fed was going to have to crush aggregate demand, raise rates a ton. We were going to go into a major recession to bring inflation down. That's a standard Keynesian demand side narrative, that demand drives inflation. Higher growth, higher demand pushes prices higher. You get that in your Econ 101 class. But that narrative doesn't really work very well because actually growth for the last 4 quarters has been accelerating and strong, and inflation has fallen at the third fastest pace in post-World War II history. We're down 530 basis points from the June highs, all while growth has been accelerating. That's not a demand side story. Now we go back before that and we look at when the inflation was rising. The first half of 2022, actually we had 2 consecutive quarters of negative growth. And inflation was rising from 5 to 9. We had this huge inflation shock. So what explains that? Well, what explains that is actually a supply side narrative. A narrative that says a lot of our inflation came from shifts in the aggregate supply curve. It came from, in your Econ 101 class, a shift back in the aggregate supply curve, which drives inflation up and output down. That was the 2021 into the middle of 2022 period. And now as we figured out how to deal with logistics problems, deal with supply chain problems, deal with all of the difficulties and inputs to production that came from reopening and COVID, that supply disruption, that negative supply shock has been unwound. And now it acts like a positive supply shock, which drives output up and prices lower. I think a lot of the inflation that we saw came from the supply side, not from the Fed being overly accommodative or even fiscal being overly accommodative. And I think a lot of the disinflation came from the unwind of that negative supply shock. The Fed has been a bystander in a lot of this. And in fact, their policy, while very aggressive and easy to start, really hasn't been as tight as the 525 basis points would suggest. Where does that leave us? I think that leaves us with a Fed that's higher for longer. They still have 4% inflation. They still have a lot to do. I think that's a Fed that, in general, wants to make sure that it maintains the anchoring of long-run inflation expectations, that Jay finishes the next couple years of his term and goes out as the reincarnation of Paul Volcker, not the reincarnation of Arthur Burns. Again, all highlighting a higher for longer strategy. Further, we have an election year coming up, and the Fed itself just doesn't like to get accused of being having politically dependent views. It wants to keep its independence. And as such, it's just a lot easier for them to stay at these rates, hang out, and unless something major changes, I think that's likely where we sit. And if I'm right that the balance sheet is has these stimulative impacts and it's only slowly coming down, the economy is going to chug along, maybe a little bit weaker, maybe not. We're going to have reasonable growth. Inflation will continue to be driven lower through the supply side dynamics that we discussed and a little bit of the negative aggregate demand dynamics if policy continues to tighten as QT continues next year. And we get an eventual move back toward our 2% target with the Fed having to keep rates at these elevated levels. And then we can discuss when and if QT ends and where it ends and where a neutral balance sheet is. It's amazing to me that the Federal Reserve talks to us about neutral rates and forgets entirely what a neutral balance sheet is. There's no balance sheet policy. They haven't told us anything. They didn't tell us where they're going to stop. It's almost like they've told us we'll stop when we break something, which is a terrible policy. I think they don't like the numbers that I put on it. They don't like to put numbers on it because, as Ben Bernanke once famously said, when asked about QE and how he works, he said, well, it works in practice, but not in theory. They don't have any theories for it. And economists without theories are sort of lost in the woods. And I think they want to feel potent and confident, and they don't when it comes to thinking about the balance sheet. I think that balance sheet is more important than ever. I think it was missed by the mainstream economists, the Fed, and the market. And I think we're waking up today to a higher for longer structure because we sort of know that that balance sheet is still contributing to stimulus in the economy. I think we're at a reasonable stopping point for some questions. So let's go there.
This has been awesome, David. I've taken like 2 or 3 pages worth of notes. A couple of questions that came in from the group that I thought would be helpful. One is there a breaking point for yields where it affects the U.S.'s, where it affects our country's ability to fund its debt burden? And what would how would the Fed react to that?
So, I mean, we are a country that prints its own liabilities. So the answer really is no. We have this wonderful thing called a printing press, so we never run out. Will we lose credibility? Will the value of the dollar go down? Sure, if people lose faith in the U.S., which they have not. Inflation expectations have remained fully anchored. I don't think there's an easy answer to the breaking point. I guess, of course, there's probably some level where people lose confidence in the central bank. But I think we're a long way away from it. Japan's got a 250% debt to GDP ratio. Ours is about 122, half of Japan's. Nobody's talking to me about Japanese fiscal policy run wild, even though it has. By the way, they have great infrastructure to show for it. They got great trains and roads and bridges and airports, but they don't grow. So I think we're a long way from that discussion point, a lot longer than people think.
Excellent, thanks. Second question, how does the recent surge in the strength of the U.S. dollar play into rates and inflation expectations?
Good question. I think the higher real rate structure is very dollar supportive, and we can see that. We've seen, with the exception of very few commodities in the energy space, the dollar do its usual thing. It keeps commodities a little lower. It's keeping inflation on a disinflationary track. It's probably weighed a little on EM assets. I don't expect that to change anytime soon. If you buy into my higher for longer story, then these real rates are going to have to be here for a while. But growth in the U.S., I think, should be okay because of the offsetting stimulus that comes from the balance sheet. So we really have to reassess what assets get driven off of real rates and what assets get driven off of policy related to the balance sheet, QE. It's actually kind of a hard thing to do. But, where you spend a lot of time, the real estate markets, it's pretty interest rate sensitive stuff. So what are we talking about with higher for longer? We're talking about periods where people are going to have to think about those higher hurdle rates and those higher funding rates. So I think private equity, the equity related to commercial real estate or that's embedded in commercial real estate, all these things need to think about what the new or longer lasting interest rate structure is. And maybe we're in a world where we have a higher balance sheet as an equilibrium, which I think the Fed would like, I think the Treasury would like, and I think the banks would like. But that's a tailwind to the economy. That produces higher nominal growth, higher income, which is a tailwind to overall valuations. Everybody focuses on the negatives in assets from higher real rates. But if higher real rates also come along with higher growth, you know what? It's not that bad. That's the 90s. 90s weren't that bad. We had higher growth and higher real rates. Maybe we have a little bit more of that to look forward to.
All right, maybe diving in a little more specific to real estate, as you said. You talked about the last neutral period being the early 2000s, or at least pre kind of great financial crisis. For us in commercial real estate, do you think that both interest rates and credit spreads would be similar to that period? Are there extrapolations we should draw for as we kind of think about our business?
I think there's a lot of extrapolations that you should think about. I think it's, for your business, I think it's quite different in big cities versus, regions, given, things that you're probably best suited to answer on the work from home, the change in demographics, issues that are plaguing a lot of the bigger buildings in the bigger cities. But I think, we may be in a period where interest rate structures are not going back to what people got excited about for the last 5 or 10 years. Sorry, I'm losing my voice a little bit. And I can tell a story where neutral becomes higher even a few years out. Now, it doesn't have to be significantly higher, but even if it's 100 to 150 basis points higher, that's enough to really change valuation structures.
For sure. And then one thing, if I heard you correctly, and I may not have, but you said the excess stimulus still in the system makes the effective funds rate more like 3.25, not really 5.25 right now. And you called it maybe neutral, maybe slightly restrictive. Is the Fed going to focus on raising that rate through continued rolling off of their balance sheet or more rate increases? Or what do you think? They don't talk about the balance sheet, but how are they going to do what they need to do?
Well, look, I think one thing's for sure. The Fed's a lot happier than it was a year and a quarter ago. In June of last year, Jay was being compared to Arthur Burns and the 70s Fed, and stagflation was all the rage. He's got a 3.7% inflation rate now. He's got the unemployment rate sub 4%. Nobody's really on, the Squawk TV programs complaining about Jay anymore. So I think he's going to kind of just ride this. He's going to keep rates a little higher. He's quite happy to do it, especially if the unemployment rate stays where it is or goes up just a bit. That's what they've told you. And I think they just want the balance sheet. They want to learn about the balance sheet. They don't want to do anything abrupt with it, and they're just letting it roll. And it's slowly tightening. And it will continue to slowly tighten.
Excellent. Maybe just two more questions. One is, just what do you think as we look at the shape of the yield curve? What's kind of your thoughts as we roll through the next 3 months, 6 months, 9 months, a year? What's going to happen?
So I think we're ratcheting up expectations for neutral real rates, at least over the short to medium term. And that's going to affect longer term rates because long-term rates are just a risk-weighted average of expected future spot rates. So I think that brings longer rates up and has done. And, that's been a kind of healthy steepening. I think we were unhealthily projecting rate cuts, and a very inverted curve was projecting recession. So we're sort of moving away from that. The curve's a little closer to 5% at the front and 4 3/4 to 4.5 in the long end. That seems more sensible than a curve that's inverted by over 100 basis points. So I'm happy with that. I do think if I'm right about the balance sheet, this curve signal of inversion that we usually get, it has to be augmented by the balance sheet. It's because what the curve used to tell us was how tight monetary policy was, that we had this big inversion. But now short rates are kind of obfuscated or augmented by this extra policy in the balance sheet. And so really the curve isn't comparable as easily to the past curves when they gave us recession signals, because in those past periods, we didn't have accommodation coming from the balance sheet. So even though the short rates are telling you we're very tight, the short rates adjusted for the QE are actually not that tight, which is probably why the curve was a bad indicator of recession and continues to be a bad indicator of recession until we get the balance sheet back toward a neutral level.
Right. And final question, I know we're out of time here, but just really curious, recognizing that the Feds, they have this term that's called the totality of data that they focus on. That's a lot of data, but do you have a few key economic metrics that you most closely watch, and why are those your measures?
So look, I think Jay will be obsessed with making sure that he goes out in a little over 2 years as the guy who slayed the great COVID inflation. He wants to go play golf and hang out with his buddies down in South Florida and really be the reincarnation of Paul Volcker, not Arthur Burns. And so I think core CPIs continue to be the most important data. We had a big pickup in PPI today, which I don't think they're going to like. Let's see what happens with CPI tomorrow. But the last CPI was actually not that great. It was still a monthly increase of 0.3. That's a 3.6% annual run rate. That's not where they need to be in core. So they have work to do. Look, we're not at 8. We're not at 9. We're not at 7. We're back in, the realm of what we've been used to over many decades, a little bit higher, but not much. But I think that the key data here really is much more related to inflation and inflation expectations. Inflation expectations have been perfect. Jay's got everybody believing he's in control, and eventually we'll get back to 2% over the coming years. But I think the obsession point is really inflation. I don't think a job weakening story is going to get much play. It'll be politically difficult for Jay next year in an election year because Maxine Waters and Sherrod Brown and Elizabeth Warren are going to send nasty notes telling him to cut rates. Janet Yellen and Lael Brainerd may be calling over to push him a little bit. But Jay's reacted pretty badly when pushed by politicians. And he knows that's what the risk is. If he does let inflation creep back in, he does go down in the history books the way he doesn't want to go. And as I think we all know, as we get older, you care about your legacy as you get older. And I think that's where Jay's head is. I think he wants a legacy of the guy who did the right thing for the central bank and made sure that inflation expectations did not de-anchor. And if he goes out with inflation hooking back up, I think he doesn't get a great write-up in the macroeconomic textbooks of the next 20, 30, 40 years. And that's not where he wants to be in the history books.
Makes sense. Well, thank you. That's all the time that we have for today. This was awesome. I doubt, there are a bunch of things. I know you obviously were way smarter on economic policy than I am, but that was also not the only contrast. I think people probably saw that we have a difference in hairstyle. Maybe we'll have to work on getting that for the next time, the contrast there.
We'll neutralize that through time.
We'll neutralize that over time with the balance sheet. That's exactly right. We look forward to continuing to deliver unmatched insights and opportunities to our clients at Berkadia. We appreciate everyone for tuning in, and we'll see you next time. Thank you very much.